So I recently watched a video on YouTube by Ray Dalio on essentially the rise and fall of empires, and it's based on his book called "Principles for Dealing with the Changing World Order." And really, the video is an extended ad for his book. But the book essentially looks at the cycles of nations over the past 5 centuries in an attempt to make sense of the evolution or cycle of nations and global economics. And for my statistics nerds out there, he uses a multi-factor model to explain the relative power of a country in relation to its peak, focusing on 8 variables, including education, technology, competitiveness in global markets, economic output, share of world trade, military strength, power of financial center for capital markets, and last being strength of their currency as a reserve currency. Now, I'm not sure how he is exactly measuring and quantifying each metric or variable here, but I assume that he does cover this in his book in more detail. But just keep this in mind if you do end up watching the video. But using this multi-factor model, he plots out the power of the great empires going back to about 1500, as shown in a snapshot here from his video. And being a history buff, I really enjoyed the about hour-long video, and it raised me to question, who is this Ray Dalio guy, and why should I take anything that he has to say about economics and the rise and fall of empires? So I thought that I would do an investor spotlight segment on him to get an idea of who and what kind of investor he is. So to give a quick rundown on his life here, Ray was born in 1949 in New York and graduated with a finance degree from the Long Island University in 1971. And Ray's early life has actually like an interesting parallel to Peter Lynch's, as just like Peter, Ray actually caddied at a golf course where he met many Wall Street veterans, which eventually got him more interested in investing and helped him get a job at one of their trading firms. So the moral is, if you want to manage a successful investment fund, the fast track is to become a caddy at your local golf course. Obviously, I'm just kidding. But I thought that it is kind of a funny parallel that both of them did this and it got them into an investing. Now, Ray considers himself to be a global macro investor, meaning he invests around economic trends such as changes in exchange rates, inflation, and GDP growth, mainly focusing on currency and fixed income markets. Now, in 1975, Ray founded the hedge fund Bridgewater Associates in his 2-bedroom apartment in New York and has served as the co-chief investment officer since 1985. And Bridgewater has become one of the largest hedge funds in the world with, I believe, about 124 billion under management as of April 2024. And he's also an author of several books, but just to touch on a couple here, his second ever book was called Principles, which was published in 2017 and focuses on his investment philosophy. And his most recent book is the one I briefly mentioned before, which is called Principles for Dealing with the Changing World Order, and was published in 2021. And again, focuses on looking at the factors of long-term empire and economic cycles. Now, Bridgewater Associates has 3 different hedge fund strategies, essentially, or funds. Its first was Pure Alpha Fund. This is its flagship fund created in 1989, and it invests across a diverse set of asset classes, including bonds, currencies, stock indexes, and commodities. And this has been closed to outside investment since 2006. And since 2005, it is reported that the annualized return has been about 4.5%. So it has been underperforming the S&P 500. Now, his second is the All Weather Fund, which was launched in 1996. And after 2008, there was a little bit of a shift in the strategy, which focuses more now on inflation-linked bonds, T-bills, and bonds, and gold. And his Pure Alpha Major Markets Fund, which was started in 2011. And this is similar to the Pure Alpha Fund with more advanced liquidity for European bonds. Now, I looked up Bridgewater Associates 13F filing, and they own hundreds of companies and several ETFs. Now, keep in mind, this is just showing their equity holdings and does not disclose, any of their currency overlay or fixed income investments. But I'll just scroll through the 13F a little bit here just to show you what it looks like. So you can see here, there's hundreds of companies. They've got 217 million in advanced microdynamics. $685 million in Alphabet, and the list really goes on and on. But I really wanted to show that, there's tons and tons and tons of stocks. But if we look, he does have a significant holding in, the S&P 500 ETF, about 1.2 billion here. And he also has about 4.8 billion in the Spider S&P 500 ETF. So realistically, this is what we would call, over diversification, in our opinion. You could really list any stock to me, any big US stock, and I'm sure that he owns it in some piece here. But yeah, I just wanted to quickly go over that there to show. Now, finally, here, just to leave you with a Ray Dalio quote, he says, "Get rid of irrelevant details so that the essential things and the relationships between them stand out. As the saying goes, any damn fool can make it complex. It takes a genius to make it simple." And really, I kind of wanted to just take it full circle with, what we look at. This simplicity and focusing on the relevant relationships reminds me of, the stat that we have referenced time and time again on the podcast by Jenga Partners, which indicates that all stocks that gained 10x or 1,000% plus globally between 2012 to 2022 had, the following commonalities that are driving share price returns. 87% of all global equities that went up 1,000% or more over the past 10 years started as micro or small caps. Again, 82% of those were profitable at the start of their ascent. 91% had some history of profitability. So I guess the thing here is that I'm just getting at, I like this quote that he has, get rid of, the noise and focus on what drives stock price returns. And yeah, that's my segment on Ray Dalio. I don't know if you can really take his book, perfectly in that, what he's saying and about like the downfall of empires and whatnot. I think that it would be an interesting read. I was saying to the guys on the podcast previously that I'd like to get my hands on the book to really look into, the variables that and how he's calculating the variables and whatnot. But it was interesting looking deeper into him.
Yeah. I would say I like the quote.
Comment. Sorry, go ahead, Ryan.
Well, I was going to say I like the quote. I don't, when you went through that portfolio, not a ton of conviction.
No.
And then,
Ryan just made the exact same comment that I.
Sorry. Yeah.
No. I'm saying that just because it makes sense. That's also what I thought. Yeah.
I mean, the quote sounds great, and I think that's a great quote. And then you look at the investing versus say Warren Buffett, who there's such a, he makes a great idea count. Like that's what he does, and I think that's allowed him to profit long term. Obviously, Ray has done well for himself. Has he done well for clients long term? I mean, you went through those returns.
That's another thing. It seems that getting the returns isn't simple either. So.
Yeah, like I said, like since 2005,
it's not as simple as it should be just to even understand what the. Sorry, Brendan.
Yeah, I was just saying, like since 2005, his like flagship fund, compound or like an annualized return 4.5%.
Yeah, I mean,
not great. And like I even was like looking at articles, like there was like a flock of capital pulling out, I believe, in 2023. I believe. Don't quote me on that exactly, but he's definitely been under scrutiny recently, just due to the underperformance.
Awesome.
Yeah, I don't know. I will say, I think he might have. I don't know if he's not running the fund in the same capacity since 2017. I think that's when he stepped down, or if he just took a backseat role.
That is correct. Yeah, he's taken a backseat role. And like, I think that's like another concern where we're kind of seeing this like flock of capital leave is, who's going to be at the reins and, can they, it's key person risk essentially, when all of a sudden Ray leaves essentially. But anyways, yeah, I thought it was a cool little segment just to kind of dig in and, kind of look through his, the 13F there to see what he holds. But exactly, like, I think maybe I could be wrong, but like maybe his conviction does come more with, again, the currencies and fixed income, but like I don't have access to looking at that. But like when we look at like equities exactly like these guys were saying, it doesn't really align perfectly with his quote there, when you're just holding the market time and time again, or like, he's hundreds and hundreds of stocks.
Yeah. Yeah, and we always talk about how you can have a well-diversified portfolio with 20 stocks. So I'm not sure why it's necessary. And then you can have some conviction. And if you do get a great company in there, a couple great companies that can power your portfolio, and that's kind of the philosophy we've used for decades now.